Hello everyone, and welcome to Mackenzie George & Company's presentation on audit proofing your business. This is one of the seminars in our Navigator series of seminars, and this video is just a short version of the full seminar that we put on. But it's a very important seminar in the series. Once you've gone through the process of acquiring a business, done the business evaluation, and studied the financial statements, and you've come up with a good candidate for a business and purchased it. Now what we want to do, of course, is build a business so that we can grow it and achieve higher levels of profit. But what many people don't understand when they're building a business is that as their revenues increase, so the possibility of fraudulent activity happening in the business increases as well. So we need to set up efficient processes and procedures to make sure that the chance of fraudulent activity happening within the business is minimized. We also have to make sure that things are set up, processes and procedures and policies are in place to reduce the chances of the business falling into legal liability exposure. So just as important as growing your business money-wise, it's important to grow your business audit-proof-wise, to make sure your business is operating efficiently and effectively, and that the chances of internal and external fraud are minimized within the business. So that's the reason for this seminar that we are doing today. Why build your business? Well, we've already reviewed this in previous videos, but we want to have financial independence. We want to have control to be able to build our business. We want to build an inheritance for our family so that we can leave more to our family than what we started with, and build a legacy. Of course, you want to pass your business on to the next generation and provide them with an income stream. When we look at a business, any business that you look at, you can essentially separate it into four main areas: operations, marketing, administration, and finance. Now, in previous seminars, we've spoken about the fact that the business owner really has to concentrate on three areas: strategy, long and short-term strategy, capital allocation, and marketing. All other components really should be delegated out to other people, but the marketing, the strategy, and capital allocation are going to be the three pieces of the nucleus to your business that are going to enable it to grow. And we see that marketing is the second one in these four areas that are prevalent in any business operation. Of course, we run a business because we would like money and time, and as we put planning into the process of building a business, we're invariably going to have to plan for these four areas: the operations, marketing, administration, and finance. And once we look at these four areas, we'll see that each business has four cycles that we need to keep on top of. We need to make sure that these four cycles have efficient policies and procedures in place so that in each of those four cycles, things are being run effectively. Now, when I say effectively, it means that our costs are under control, that the chance of fraud within the company is reduced, is minimized, and we don't have legal liability exposure through theft or fraud or anything like that. The four cycles that invariably will be audited in an internal audit or an external audit, you'll see, are the revenues and receipts cycle. That's the cycle where money comes in. Acquisition and expenditure cycle, where we're actually spending money out on capital or otherwise, other expenses. Payroll and personnel, the payroll cycle for paying employees, and the production cycle for actually producing our goods and services. Now, within each of those four cycles, you'll see that there are three main processes in place in each of those four cycles that need to have policies in place directing the people on how to undertake those processes. The first process is evaluating and testing the internal controls within each cycle, making sure that there are controls in place to minimize fraud. We also have to test these internal controls and test the procedures within each cycle to make sure that they're operating as we want them to. And we also want to segregate duties within each of those cycles, meaning that employees cannot have more, the activities that they take on in each cycle, they can be related to one another so that they can independently engage in fraudulent activity. An example of giving an employee too many tasks so that they can be open to fraud would be someone in the accounts payable department who has the authority to both pay invoices, i.e. process the checks and also sign the checks. That's an indication that they have access to engaging in fraud in the company. We don't want that. Now, this is kind of a truncated version of the seminar, but once we've set up all our policies and procedures to make sure that the tasks are defined and that the chance of fraud happening in the company is minimized, you as the business owner also want to have a quick reference chart to be able to monitor your business's performance just on a snapshot. And this is what we call the balanced scorecard. The balanced scorecard was a very popular theme in the 90s and in the early 2000s, and it continues to be a popular theme. And it basically entails taking key performance indicators, or KPIs, and looking at these indicators and determining whether or not they meet the parameters that the business owner has set in place. If our KPIs are in line with our parameters, then we can have confidence that the business performance is acting in accordance with our plans, that we're going towards the realization of our long-term goals. Okay. When our KPIs are off kilter, or when they're not, when we're not meeting the indicators, when we're not meeting our numbers, then it's time to drill down further and find out what's going on, what we have to do to right the broken ship, if you will. It's normal to have key performance indicators that include net income, operating margin, your accounts receivables, your operating and collecting cycle, and your debt to equity ratio. And for common reasons, we want to make sure that our net income is stable and it's not falling, it's hopefully growing. Now, sometimes your net income can fall due to economic conditions, but that would just be a short-term lag. Your operating margin, your accounts receivable, you want to make sure your receivables are not getting out of hand, that you're collecting on your accounts. Your operating and collection cycle, again, if we were actually sit down in a seminar, we would go into further detail on these cycles. The debt to equity ratio, we want to make sure that our debt is in line, that it's sufficiently handled with the cash inflows from our business, and we want to make sure that we're achieving the return on investment that we want to achieve. So when we look at the paradigms, money and time, and then the four main areas of a business: marketing, operations, administration, and finance, we can equate a key performance indicator to each of those paradigms. So money and time, really how we're going to be able to achieve the objective of more money and time, more time, is through net income. We want to establish net income. Marketing, our operating margin is going to determine the success we have in the marketing area of our business. Our operations, again, the accounts receivable performance indicators are going to determine the success of our operations, and so on and so forth. The exact parameters that we want in each of these key performance indicators, and these are parameters that really facilitate the realization of the business growth model. That's another seminar that we put on. But we're looking at net income in the 10 to 20% range, depending on the industry, an operating margin of 50 to 60%, and then we'll have administrative and overhead expenses of around 36% to bring the net income down to the 10 to 20% level. We really want to keep our accounts receivable in check, no more than 10% age receivables over 30 days. Preferably it comes right down to zero, but in certain industries it's normal practice to pay in 60-day periods, and you can't get away from that depending on the industry that you're in. An operating cycle and collection, you'll see the parameters there. We keep these parameters, we have these parameters so that your business can stay in check and so that the cash inflows are sufficient to sustain the business and keep it solvent. And the ROI, although you can't see it there, the ROI is really in the 15 to 20% range, which is in line with the net income. I have a quick chart here, the relationship between the debt ratio, the weighted average cost of capital, cost of equity, and the cost of debt. You'll see that this solid purple line is the weighted average cost of capital. The dotted green line is the cost of debt, and the blue line is the cost of equity. Basically, this chart considers, okay, I have two ways to finance my business, one through equity, one through debt, such as from the bank. Equity is coming straight from your pocket, and the cost of debt is coming from banks or from other financing sources. But because of the tax advantages inherent in debt, i.e. you're able to write off the interest on your debt, it makes sense to combine the two financing sources so that you can minimize your cost of capital. And that's what this chart represents. As we increase the level of our debt compared to equity, we can actually reduce the weighted average cost of capital than if we exclusively financed our business through equity. So if your business was to cost you $200,000, let's say, we could actually reduce the overall cost of purchasing that business by taking a hybrid approach to coming up with the $200,000. Rather than taking $200,000 away from your bank account, why don't we take $100,000 and then finance the rest? Because the interest on that $100,000 can be tax deductible and therefore reduce the cost of purchasing that business. So every time you want to purchase a business, we have to do this calculation on the weighted average cost of capital, which is an important calculation to make. So the summary from this seminar, we want to keep tabs on our business parameters. We want to define the business parameters that we have for our business going into the business, and the business parameters provide a key strategy going forward. We want to have a process in place to realize these business parameters. Market parameter comparisons. Well, we want to have parameters that are in line with the market that we're in. We can't have unrealistic parameters because the market that your business is in is really going to a certain extent define the parameters for your business. We want to make sure that we implement the processes of the business in an efficient and effective manner, have policies in place. By doing this, we're able to minimize the chance of internal fraud within the company, and we want to regularly monitor these processes to ensure compliance with the company's short and long range goals. By regularly monitoring the performance of these policies and procedures and processes, at the end of the day, you're really going to be able to keep your costs in check by regularly monitoring your operations. So a summary, we get into business to achieve money and time. By purchasing a business, we have to concentrate on the 4 areas of business: operations, financing, marketing, and administration. And by doing that, we have to keep checks on the 4 cycles that are in each business. The 4 cycles are revenue and receipts, acquisition, expenditure, payroll, and personnel, and production. And these are the 4 cycles that will be thoroughly reviewed in any internal or external audit. And within each cycle, we're reviewing these 3 processes: testing the internal controls in each cycle, testing processes in each cycle, and segregating duties in each cycle. So thanks very much for joining us. We hope this has been good information for you, but just let me reiterate that just as important as increasing the revenue in your business is making sure that the business is tight and is not exposed to fraudulent activity or legal liability. So thanks for joining us.